All righty. Welcome back to the I Love Annuities podcast. I'm Jeremiah Conger.
And I'm Zachary Van Ness, and we are the Annuity
Dudes. And today we're going to be pulling back the curtain on one of the hottest topics in retirement now. What's really happening with today's annuities rates of 2025?
Buddy, it's been busy.
A lot of stuff changing.
A lot of changes. A lot of folks we're talking to. Rates have been on the move. So really, whether you're looking at multi-year guaranteed annuities, where you're getting that fixed rate for a designated period of time, if you're looking at single premium immediate annuities, where you're getting that lifetime of income, or fixed index annuities, what's happening this year could make a big difference in long-term income strategies.
Yeah, and ultimately, a lot of these changes are taking place because there is a high correlation between annuity rates and what the Fed is doing and how the 10-year Treasury rate is also being influenced. So today we'll walk through the latest MYGA, SPIA, and fixed indexed annuity income rates and what's driving the movement ultimately, and when it might make sense to lock in versus wait.
That's right. So what we'll do is we're just going to dig right on in. We're going to jump to it today because 2025 is shaping up to be a pretty interesting year when we take a look at the most recent 20 years compared to the market.
Yeah, I mean, we've seen interest rates within annuities anyways go from, when I was looking at MYGA reports the other day from back in 2020, and I think the MYGA rates were like 2.5%. And today they're almost 3 times that much, or that high, that high. So it's a lot has changed with the interest rate environment, but now we're on the downward trend here, and we're going to see how it shapes up with the annuity market.
That's right. So we're in a little bit of a rare sweet spot here when it comes to these rates. I'll let you take over here real quick.
Yeah, I mean, we're in what I would say is the best time to buy right now that there has been in the last 20 years. And that window is slowly closing. That opportunity is slowly going away because of the shift in the downward trend towards interest rates. Annuity rates have been very strong all year and largely held steady throughout most of this year, but MYGA rates are still being found in that 5.5%, somewhere close to 6% range, depending on the term. And income payouts have remained at multi-decade highs throughout this year, but we are starting to get the communication from the carriers that these rates are starting to go downward. We're starting to see how that's influencing the market. And really the premise of this show is to just bring the light to that and let anybody know that if you are on the fence, if you are starting to consider, still thinking about it, wanting to consider maybe buying an annuity of some sort, that window of opportunity is starting to close, at least in securing these higher multi-decade high rates.
Yeah, so we've seen some changes recently. And really, if you know, as you may know us already, part of our process here is that we're going to take you through the entirety of the marketplace. So when we talk to you, find out what's important to you in your planning. We want to be able to bring that marketplace to you first and foremost, so that when you're making a decision, we're making that collaboratively and we're finding out where the best fit is for you.
Yeah, the mission of our organization is to create a better annuity buying experience. And that process is founded on trust. And we build trust through the transparency that our process provides. So if you do end up meeting with us, or if you have met with us in the past, you can attest that we offer a very transparent process by essentially bringing the entire annuity marketplace directly to you with your own eyes, leveraging technology between our software that houses all of the annuity rates, and then also by leveraging Zoom, which gives us the ability to have a screen share where we'll show you the entire marketplace from A to Z, depending on the type of product. And we'll show you exactly what those rates are and help you ultimately make a better decision. But that's done through transparency. And I think the purpose of our episode today is to bring that transparency to this episode. So we're going to do that with having a live screen share of what the current rates are across the marketplace. And we'll start with MYGA rates. What do you think, Zach?
Yeah, let's start there. So just as a reminder, a MYGA or a multi-year guaranteed annuity, sometimes called a fixed rate annuity, what it's offering is a guaranteed rate for a specific amount of time. And this is intended primarily for the purpose of growth. It's not here to typically service a lifetime of income. It's safe market growth. I think a lot of the clients that I run into, and yourself as well, Jeremiah, maybe an alternative to a CD.
Yeah, and they can be used as a supplemental income stream. There are some of these MYGAs that offer free withdrawal provisions or riders that you can add that allow you to take a free withdrawal per year. Sometimes that's interest only. Sometimes that's 5% or up to 15%, depending on the specific product. That then somebody in theory could take that free withdrawal. We can even have it scheduled where that withdrawal is systematically deposited on a monthly basis to act as a supplemental income stream. And we do have people that do that from time to time. And I think if you just need a little bit more money on top of what you already receive, that makes a lot of sense. But ultimately, like Zach said, it is a growth vehicle primarily, but it can be used as a supplemental income stream at times.
All right, let's jump on in and see if I can figure out how to use this. Let's see here, window. All right. Can you see my screen?
I can.
Awesome. So like we've talked about, this is software that we use to take a look at the marketplace. And this is a quick screen share of what the marketplace would be in the case of an individual looking for a multi-year guaranteed annuity or a MYGA. With this, we can see as we scroll through the options, rates varying. And you can see as an example, a 3-year up to 6%. And this is going to be dependent upon our clients' needs, what's important to them in their planning, and what might suit them today and for years to come.
Yeah. So we'll see that that 2-year is right at 5.25%. Going into the 3-year, we're looking at the top product being Wichita National at 6.1%. And then moving into, let's go to the 5-year. 5-year being again another Wichita National at 6.25%. Now we have the ability to filter these options based upon what you deem to be most important to you, whether it be financial rating by the carrier. If you prefer an A-rated over a B-rated company, we can filter for that and make sure that we're only looking at higher financially rated companies. If it's in regards to having that flexible free withdrawal provision, whether that's 5% or more, we can narrow that down, find the product that's going to give you the highest free withdrawal per year, followed by the highest interest rate offer per year that's guaranteed. Regardless of what we see here, we can filter that based on your specific situation and your preferences.
Yep. Yeah, exactly.
So we've got the 5-year at 6.25.
Go back. Yeah. So 6.25 without any withdrawal provisions. We do see the alternative from Wichita National just below that, where that rate dips a little bit to sacrifice, if you will, to get that withdrawal provision, the ability to make withdrawals of up to 10% per year. You'll notice this is saying there's no free withdrawal in the first year, but anytime thereafter, up to 10%.
Yeah, some of these MYGAs have the ability to add a free withdrawal rider. In this case, this Wichita product is doing just that. They're adding the rider to have that 10% free withdrawal. Therefore, the rider is costing us 15 basis points off the rate that's initially offered at 6.25. So it brings down that net rate to 6.1% if you needed the free withdrawal added.
Right.
Sometimes people get that. Sometimes people don't. It's really just about personal preference and what your goals and objectives are.
Yeah.
Let's look at the 7-year and the 10-year rates, Zach. So we'll see the 7 years currently coming in to another 6.1%. The rule of thumb is not always as it doesn't mean the longer term you go, the higher the rate. Oftentimes that is the case, but not always. In this case, it's not. The sweet spot in this instance is a 5-year at 6.25. But some people have the preference that, hey, we know that we're in a high interest rate environment today. It is starting to show indicators that we're going to be on the downward trend there. It makes a lot of sense to lock in the highest rate you can get for the longest period of time so that you can basically mitigate the risk of a low interest rate environment for a prolonged period of time.
Yeah.
We had just gotten out of that, back in, if you go back to 2020, just prior to 2020, we were essentially in a zero interest rate environment. It was as close to zero as it's ever been in history.
Right.
And
Right.
we've kind of gotten out of that since all the money was printed from the COVID crisis. But we're going to be on that trend downward again. Who knows what that means? We might be in a prolonged low interest rate environment, which therefore, if you locked in, let's say this 6% rate or sub 6% rate for 7 years or maybe even 10 years, let's see what the 10-year rate is.
Yep.
It's at 6.05.
Yeah.
So, you could lock in a 10% guarantee, or I'm sorry, 10-year guarantee at 6.05%. Some people would say that that's a very fair rate of return considering there's no risk to the markets and you're locking it in for a long, long time.
And
Go
as
ahead.
you notice, you're going to see right now, all that's popping up are the top 3 rates for that selected term, right? So again, as Jeremiah had mentioned, if there's different criteria that we're looking for, we can sort that accordingly. But there are a lot more options to choose from when looking at these terms. This just happens to be categorized based on the highest rate.
Yeah. And, if you compare this to these bank CDs, which is essentially what a MYGA is, it's equivalent to a bank CD, with the difference being that the rates that are backed and guaranteed are offered by an insurance company versus a bank. So you don't have the same FDIC insurance covering the annuities as you do the bank CD, but annuities themselves, the fixed annuities, are backed by your specific resident state's insurance guarantee association. Oftentimes those coverage limits are very equal to an FDIC type backed product. In most states, that coverage limit on fixed annuities is up to $250,000.
Right. Right.
I'm pulling up the CD rates. A 5-year CD rate on bankrate.com, the highest that I'm seeing here is 3.4%. Now, I have found a 2-year rate at 4.25, but ultimately, with CDs,
2-year options for an annuity at what? 5.25. Yeah.
So, oftentimes MYGAs are higher. The rates are higher on MYGAs than they are bank CDs. So it's a really great product for those trying to really protect their money, grow it at a safe, fair rate of return with no risk to the markets.
I think a big forgotten component to the MYGAs is that tax deferral and the utilization of that. Sometimes the conversation comes up and, oftentimes the comparison is there with a CD, and there's big difference there in that tax deferral component.
Right.
All right. Awesome.
All right. Yep. So, and I know that on the screen, if you're watching the screen share, the software showing quite a few B-rated companies. Reason for that is the B-rated companies have to be more aggressive in order to gain market share. So they're going to offer higher rates than, say, an A-rated carrier will do, and that's all because of, the stabler, or I won't even say more stable companies. I will just say the A-rated companies don't have to compete as strong because they have that A-rated backing. So that naturally already creates a whole nother opportunity of premium through transactions that will naturally come because of the A rating. People do prefer that over a B rating. So, naturally the B-rated companies have to be more aggressive in the offer to get people to consider them. Otherwise they could never compete. But again, if you have a preference on that, which many do, that's perfectly fine. We can fine tune this and, filter it out for those A-rated or better companies.
Right.
All right, let's move on. So we've talked about MYGA rates. We've talked about current CD rates and how those differ. Both are correlated to the federal funds rate and how that influences the 10-year treasury. But in addition to that, there is other annuity products, and I think that'll be right where we segue into SPIAs. Let's talk about SPIA payout rates. So for those not familiar with SPIAs, that is the acronym for Single Premium Immediate Annuities. What's known historically as the gold standard for guaranteed income. It was the first of its type to offer guaranteed income. It is a fully annuitized product, and where you're relinquishing control over the premium investment that goes into that product in exchange for a guaranteed income stream. That guaranteed income stream can be structured to be guaranteed for life. It can be structured to be guaranteed for a joint life structure or setup for a couple. It can also be guaranteed for just a duration of time, whether that be 10 years, 15 years, or 20 years. And then once that time has been eclipsed, then it stops. It's fully customizable in that regard. It's a pretty neat product when you start playing around with it and how you can kind of leverage it to create a full plan. Sometimes, here at our firm, we'll use a SPIA in combination with a MYGA, or a SPIA in combination with an indexed annuity with an income rider to meet the goals and objectives, but do so in a creative way that optimizes the income stream. So essentially what we're doing is giving us the best deal, as you as clients or prospective clients, giving you the best deal to get the highest amount of income with the least amount of premium to get it. And sometimes that incorporates using a SPIA and an income rider product to do that. Well, why don't we go ahead and take a look at SPIAs right now?
Yeah. So, as with anything, the information is only as good as what we input and how accurate that is. So based on the criteria that we input, this will produce the outcome of what carriers are available with the criteria we've input. So this will organize the carriers based on highest rate, or in this case, highest monthly income. And in this case, we're seeing Equitrust as the top option. I gave a quick scenario of an individual who's male, 70 years old, starting income in a month. And this would continue as a lifetime of income based on a premium of $100,000. So if we scroll down the list, we'll see several different carrier ratings. And again, it doesn't mean this is a one size fits all and that we just assume the top rated carrier. Oftentimes we need to find out where our client's comfort level is in terms of the carrier they're working with. So that's part of our conversation.
So this is based on a 65-year-old male structured for single life on $100,000, correct?
I think I have it at 70. Let me go back.
70?
1955. That would be
70.
Yeah.
Okay. So let's do one for 65 as well. So change that to 1960.
Yep.
So right now, if we calculate that 70-year-old payment, just the way that I look at SPIAs is I look at what's called the cash flow rate. How much income are you getting for every $100,000? In this case, the highest option was from Equitrust at $777.69 a month. So what you do is you just multiply that by 12 months to get the yearly income or cash flow. And then you divide that by the $100,000. That puts us at a cash flow guaranteed income for life at 9.3%. So on that 100K, that asset is producing a guaranteed income stream for the rest of your life, 9.3%. That's pretty solid. There's not a lot of products out there that could even get close to that. I think that's the most important statistic to look at is the cash flow percentage or the payout percentage.
Right.
Bringing it down to a 65-year-old, that cash flow now is going to go down a little bit because it is tied to life expectancy. So these products are built using actuarial science, and they determine the income payout rate or the cash flow based on your life expectancy. So for a 65-year-old male, single life, the cash flow is 8.21% on every 100,000.
Yep.
8.21%. Let's go ahead and do it for 60. And this would be with income starting immediately, which is defined as being started within 30 days of policy issuance. So this is going to come down to a 60-year-old male, single life, guaranteed income for life, based on $100,000. The monthly figure is $618.63. You multiply that by 12 months to get the annual figure. That's going to come out to
$74.23.
Yep, $7,423 a year divided by $100,000. That's going to put you at a cash flow of 7.42% for the rest of your life on 100,000. Pretty solid. Now, the number one kind of objection we get, right, is does that account for inflation? The answer is no. This is a fixed level payment for the rest of your life. But what we do is we utilize the annuity to give you that foundation of guaranteed lifetime income, which takes the pressure off of the rest of your portfolio. So it doesn't have to put out that level of income, even in down markets. And then all you do is have that growth portfolio be your inflationary buffer. You take just a small percentage off of the remaining assets to supplement your guaranteed income from the annuity. And together, cohesively, it creates an optimized strategy to give you more clarity, confidence, and peace of mind that a majority of your income to cover your essentials is covered for life. But B, it takes all the pressure. This is where the optimization comes in. It takes all the pressure off the growth assets in your portfolio to allow you to be more risk oriented with those assets, allow you the wherewithal to ride the ebbs and flows of the market, but then only have to withdraw a very small percentage. We're probably talking 2.5% maybe to pace inflation, offset inflation, maybe 3%, but it's a lot less pressure on the portfolio to provide that type of return. So therefore, it allows that portfolio to grow immensely over time. The longer you stay in the market, the more money you make. That's always been the rule of thumb, right? So this allows you to do that. And as that portfolio grows larger, you're having to take less percentage to get that amount of income to offset inflation. So it's just an optimized approach to addressing sustainment of your lifestyle and the expenses associated with that lifestyle sustainment and doing it out into the future. In addition, we've talked on previous episodes like the other benefits that come with this plan. That is, the benefit of peace of mind, but also the fact that if you cognitively decline as you age, this is the easiest plan to address your income needs because the annuity is on autopilot. It's just going to pay out forever as long as you live, directly deposited to your bank account or mailed to your mailbox via a check, whatever you prefer. So it's just an optimizer in that sense too. If you do age and cognitively slow down, it mitigates that. In addition, if you do go into that situation where maybe your children are starting to have to care for you or someone else that's in your family or a loved one, and they have to start caring for you, they don't have to also care about your financial plan as much because it's already set and done for you. It also mitigates the risk of if you do have a financial advisor that's like managing a portfolio and all of your income disbursements and things. Well, what happens if that guy dies or that gal or they retire? This type of plan completely mitigates that. So there's a lot of other benefits to it that are often not spoken of, but we like to talk about them here because we know the power of this.
Right.
All right, let's move on. So we talked about SPIA rates. Let's look at income rider rates. So these are fixed indexed annuities offering a guaranteed lifetime income as well, just a little bit different in terms of the mechanics of the product. It's not a product where you're fully annuitizing the premium investment. So in other words, you're maintaining control over the money that you put into this vehicle. You still have the ability to grow that premium investment on a non-guaranteed basis according to how the underlying index crediting strategies perform over time. You also have a guarantee of principal protection on that premium investment, so it's never exposed to downside risk. So you can't lose $1 at all if the indexes were to ever perform negatively. In addition, it's still your money. If you decide down the road you want to walk away, cancel the policy, you can do that and you'll get whatever's left in that account value. Whereas with a SPIA, that's not an option in general, that you could walk away and get any money back. So what we have also seen is in some cases, income rider products, even though they offer these additional benefits above and beyond what a SPIA provides, sometimes they're even more competitive on the guarantees of income and the cash flow payouts. So let's go ahead and take a look. Let's start with a 60-year-old.
Compared to what we just had?
Yeah, let's go from 60 to 70 now. So 60, we'll start there. We're looking at a cash flow.
This is monthly or annual?
Let's look at annual.
Okay.
And then I can break it down.
All right. So 60 male, same criteria. And the way I've got it sorted right now on the rider type is so that this is as level pay. So as parallel as we can get to a single premium immediate annuity or the SPIA in terms of the functionality of how the income is received.
So the top option there is from Prudential Life with their SurePath income rider. Click that deferrals button real fast. Down below, the bottom of your screen, deferrals next to product overview.
Oh, sorry. Yeah, thank you.
They could do a better job at making that a little more visible. So this already breaks down the income to premium ratio, or what I've been referring to as the cash flow. So on $100,000, an indexed annuity that has the income rider activated immediately, which would be within 30 days of policy issue, the cash flow here for a 60-year-old is 7.1%. So I believe that's that might actually be higher than what the SPIA was paying, if I recall. I didn't write the numbers down, but
let's see here. Oh, I only had it for I know that, I believe that's higher. I'll double check it.
It was pretty close. It was pretty close. I think it was right in the same range. So I think it was like 680. Yeah. 653 or something. It was like 650. Here, I have it up. Hold on.
All right.
The last one I ran, so that was at 7.4% cash flow. This is at 7.1. So the SPIA first.
Right. So I did have that right. Sorry. I don't know if you can see my screen where that was the number that I had for, it must have been the 60-year-old.
So the 60-year-old SPIA cash flow was 7.4% on every 100,000.
Yep.
The indexed annuity for immediate activation of guaranteed income, single life, is 7.1%. So about 30 basis points difference. However, with the indexed annuity, you maintain control over the principal. That principal is a death benefit if you pass away and there's money left in that account at that time. You have the ability, again, to earn interest on a non-guaranteed basis. You can also take free withdrawals from that money, so it's also additional liquidity within your overall plan. If you need to take out 10%, most of these products, you can do that. So let's go ahead and look at a 65-year-old.
All right.
So for those watching that didn't see the screen share, that was paying an annual income of $7,019 a year on $100,000 for a 60-year-old. So throw up a 65-year-old. Nationwide comes in and with their Nationwide Peak 10 product. And again, these products are going to change. They're sort of like anything else that's tied to rates. These products can change. Sometimes you'll have Nationwide come in number one for a certain age or single or joint life structure. But then the very next week, it could be Prudential. It could be another one. So it does change and fluctuate. So what you're seeing today could be different next month. With Nationwide, the cash flow for a 65-year-old male single life on 100,000 is 7.81%. So for every $100,000 that you put in, it's going to generate a lifetime income of 7.81%. All right, That annual income is $7,813 a year.
All right, jump to 70.
Let's go.
Go. And what you're noticing, we've had a couple different carriers pop up. So really the utility of this tool that we have is proves itself when we can bring this to the marketplace and show clients, hey, it's not always just a one size fits all. If the best annuity is available, if you're 60, it may not be the same solution at different age ranges.
Exactly. And that's where also we can get creative. More of the advanced planning approach is we can actually ladder these indexed annuities with income riders and create an inflationary buffer naturally by staggering out when the income streams are turned on. And we do that by leveraging the guarantees of these income rider contracts, which have what are called roll-up rates anywhere from 7 to 10% a year, depending on the product. Every year that you defer the income, those income benefit values are going to grow on a guaranteed basis. And so we can strategically ladder annuities and take, let's say you're doing 500,000, we can break that up into 5 $100,000 contracts that are activated at different points in time in the future. And sometimes along with that, because of how these carriers structure their products, we find sweet spots where one carrier may offer a higher income if you wait 5 years with that product versus the next one. And it allows us to handpick which annuity product would be ideal in regards to meeting the highest lifetime income based on that investment and that deferral period. And with this software, it gives us the ability to strategically select which one and have an answer to that question with a high degree of accuracy. Go ahead and hit the deferrals there. While I was talking, I didn't see it.
Oh, okay.
So this one is the 65, or this is 70.
70. Yeah.
So this is 70 years of age on $100,000. The annual payout would be $8,563, or income to premium ratio, what I've been referring to as the cash flow, of 8.56% on every 100,000. Again, indexed annuities, you're not relinquishing control of the principal. So there's added benefits. Some of these contracts also include an enhanced income benefit for long-term care, where that income will be multiplied by 2 times. So in this case, if it's paying $8,563 and it had an enhanced income benefit rider, which is included in the contract, if you had a need for long-term care, that $8,000 figure would double to pay out. In this case, it'd be over $17,000 if it was a true doubler on this product, if you had a need for long-term care. So there's other benefits and things that go into these products that really make them more unique than just a general SPIA. But sometimes people say, look, I don't care about anything but the highest cash flow that I can get for my 100,000. I don't care if it's something that I maintain control over. I've segmented this money or bucketed this money for income, and that's all I want from it. So if that's the case, sometimes a SPIA might be the answer. Other times, if you want to maintain control over the principal, have the ability to earn interest on it, pass it on through a death benefit provision, or have the ability to cash it out at some point in the future, the indexed annuity is better in that case.
Right.
Ultimately, we're about meeting your needs, what you determine to be the most important thing for you. We're not here to sell you anything. We're here to show you how to evaluate the marketplace. We're here to show you how to make an educated decision. We call it lifting your annuity IQ to a higher level so that essentially you're in the driver's seat so you can make the decision. We're just here to give you our guidance. Think of us as like a tour guide. Like, here's what you're looking at. Here's how to look at this. Here's how to look at that. Look to the left, look to the right, that type of thing. And ultimately build your confidence in yourself to give you the ability to make a good, informed decision. That's been our mission from day one. And that's all we'll ever be, is living and abiding by that vision.
Absolutely. Now, brief view of what we use on a day-to-day basis to help clients in finding if an annuity is the right fit. But wanted to share that just so we can see the perspective of where the market is today and the environment we're in right now.
Real quick, Zach, before we move on to the last segment, can you show the rate scout in Annuities Genius so we can show how many carriers are announcing rate changes?
Yeah, bear with me here. Under dashboard.
Yeah, it's on the dashboard to the bottom right. It'll say rate updates.
Yeah. Okay.
You got to share again.
Yeah, I was just pulling it up, so I didn't share any
Okay.
clients' information. Are you seeing my screen?
Yeah, but that's not the right one. Go back to the bottom right on the dashboard. Go down. Upcoming rate updates right there. Explore all rate updates.
Oh, yeah.
Okay. So right now on the left-hand side, this is what we call a rate scout tool. It shows different carriers that are announcing in advance their product rate changes. So we have, what's that? 1, 2, 3, 4, 5, 6, 7, about 8 different companies announcing rate changes within the next 5 days. And you'll see the way that we can see the rate changes is on the right-hand side where it shows the rates. So we have Nighthead Life, who's a MYGA company or a big MYGA player. You'll see their old rates are coming down on, for example, on their 3-year stay sale MYGA product. The current rate today is 5.5%. For premiums less than 100,000, it's 5.75% for 100,000 or higher. That rate's coming down to 5.6% on October 20th, which is just in 3 days. So a 15 basis point rate change downward, just to prove that, the carriers are starting to align with the Fed and where their rate changes are heading. A lot of times, oftentimes, insurance companies try to stay ahead of those rate changes and price them in before they actually become reality because it's a risk that they face. So, but that's one of the tools we use to look at upcoming rate changes. That's kind of what fostered the idea for this episode was, hey, we have a ton of rate changes coming up. We need to make sure that the public knows about this. All right, let's go ahead and go into our segment here where we're looking at, section 6, why rates are moving and the economic factors that are associated with this. All these numbers really tie back to one main factor, and that's the Federal Reserve's rate environment. Fed Chair Powell announced that the rates are coming down. They cut it by 25 basis points here recently, with a future announcement of potentially 2 to 3 more rate cuts here just by the end of the year.
Right, exactly. So how does this correlate to our industry? And when the Fed raises or holds those rates, insurance carriers can earn more yield on their general accounts, and that trickles down into annuity crediting rates and income payouts.
And that's why the window that we're in right now is very unique. It's the combination of stable interest rates and healthy carrier competition. And that's what's driving some of the best offers we've seen since before the financial crisis.
Yeah, so if we look back, previous in history, we can see that certain annuity rates were higher at different points in time, whether that be 20 years ago, then for more than a decade. When we look at it, retirees were kind of stuck in that world of maybe these MYGA rates being in the 2 to 3% range.
Exactly. I mean, I remember that like it was yesterday, man. And at that time, those MYGA rates in the 2 to 3% range were great compared to the bank CD environment. Bank
Right.
CDs were at like 1%. So, the retirees of today have a rare opportunity, and there's a ton of people. They call it the peak 65 movement, where more people are retiring every day than ever in history. There's over 10,000 people retiring every day right now, and that trend is going to continue for the next 5 years. And you guys have a rare opportunity. to lock in strong guarantees while they last, because as inflation normalizes and the Fed eventually cuts rates, these offers will come down again.
Right. And it's typically a trickling effect. It's not immediate. It's not a hard stop or a hard change. So when we look at it, what's next? Well, most analysts do expect some rate softening later on in this year and then into 2026, as the Fed is expected at least to gradually reduce these rates.
And that means today's top annuity rates could represent the peak plateau, the highest sustainable level before gradual tapering begins.
Right. So how does this translate to anybody that we talk to every day? Well, if you've been waiting, it may be time to take action or consider taking action, or at least have the conversation with one of us here at Annuity Association.
So the ultimate question becomes, should you lock in now or wait? So if you're within a few years of retirement, or maybe you've recently retired and you're either looking for guaranteed income or safer ways to grow your money with no market risk, locking now makes a lot of sense. And I would consider it to be a very rational move.
That's right. And because even if rates inch slightly higher or lower, the difference really won't outweigh the guaranteed income growth you can start earning immediately.
Yeah, maybe you're not quite ready. That's okay. What you can always do, though, is at least take the first step in looking at, these annuity products, which ones might be right for you and what rates there are associated with them. And if you like what you see, in many cases, you can lock in by simply putting in an application. The application doesn't obligate you to continue moving forward with it. All it does is actually secure that rate for a window of time. In most cases, it's up to 60 days. As long as the funding arrives within that 60-day window, we can secure that high rate today. And if that rate does change over that interim, you still receive the higher rate as long as we meet that 60-day funding deadline. Now, if rates go up from here, which they won't most likely, but if they do, we can ensure that you get the higher rate as well. So you're not putting yourself in a bad position either way. You have the option to just cancel the application and move on, or you have the ability to move forward with it and secure that high rate even after the rate has gone down within that 60-day window. So it's really about considering what you think you may need, putting it, putting some skin in the game by at least feeling out the marketplace and what there is to offer. And then if you like what you see, at least temporarily, put in an application, lock it in, and then we can go from there.
That's right. So if you're ready to see where guaranteed rates are today or in the near future, or guaranteed lifetime income for your specific needs, that's what we're here for. We're happy to help. So feel free to reach out.
Yeah, we'll essentially take you through our very transparent process. We've talked about it on previous episodes. It's what we call our annuity assurance process. In that, you'll receive a complete walkthrough and a hand-holding or white glove approach to helping you understand what's available. We'll take you through our unique and proprietary process that we call the multi-point annuity inspection that'll teach you exactly how to analyze and evaluate these products using 5 to 6 key elements to help you understand them better, lift your annuity IQ, and ultimately put you in the driver's seat to hand select which annuity type and which annuity product within that type is truly right for your situation. So if you'd like to do that, we're here to help. We are, full disclosure, an independent annuity advisory firm. We do make a living selling annuities, but we take a different approach to that, and we're proud of the approach that we take. We're not here to sell you on anything. We're here to help you make your own educated and informed decision. We do that through transparency and ultimately building trust with you. And the long-term effect of that is that if we can help you in that matter, make a more confident and educated decision, that you'll buy that annuity through us. And that's how we're compensated. There's no obligation to buy through our meeting process. There's no cost to you at all, whether you buy or not. The only cost would be the time that's associated that you commit to spending with us, and the time that we spend with you. That's the only thing at risk in those meetings. So we're here to help you either way, whether that's yes, you want to buy an annuity, or no, it's not right for you. That's our job, to help you get that clarity so that you can make a decision. If you'd like to do that, in the bottom of this show note, wherever you're watching there will be a description box, which will contain a unique link to book your time to meet with some of our senior annuity advisors here like Zach. Or maybe you just want to go ahead and request a free report. You're not just quite ready to speak with somebody. There will be a unique link as well to request your free report, which will bring you all of today's annuity rates on the market for income and or growth, give you all of the high level viewing points that you need to evaluate and start. And then if you'd like to meet with us after taking a look at that report, we would be honored for that opportunity. Is there anything else that you'd like to add there, Zach?
I think you nailed it. Unfortunately, we didn't get a chance to BS a little bit today. So we jumped right in. We're busy. So wanted to share the information that we've got. We feel it's valuable that you guys see what this process might look like for you and how this can potentially help you in the future. So
for sure.
Thank you all for tuning in.
Absolutely. We're very blessed and thankful for the opportunity to speak with everybody. Thanks so much. We'll talk to you soon. This is Jeremiah Conger
and Zach Van Ness, and we are the Annuity Dudes.
Signing off.